Good afternoon, everyone, and welcome. Today we're here to examine the findings of our financial analysis of our employers, our competitors, and as well as local companies. We examined their financial metrics, and here is a presentation of my findings. Our objective was to analyze 22 companies and determine which company was best. When I say best, I mean which company is financially best. I'm looking for a financially strong company. My analysis criteria included I wanted to see a high return on equity, and I also wanted to review the DuPont analysis to see what's driving the ROE. I wanted to see a positive economic value added number, a high price to earnings ratio, a solid EBIT margin, and I wanted also to examine the relative volatility. And of course, all these financial metrics came from Bloomberg. I used the Bloomberg terminal to find all these numbers. For my criteria justification, ROE is net income divided by total equity, which can be broken down into the profit margin times the total asset turnover times the equity multiplier, or also known as leverage or debt. Furthermore, the profit margin can be decomposed into the interest burden times the EBIT margin times the tax burden. Those three factors make up your profit margin. I wanted to see a positive economic value added number. Simply put, economic value added is earnings after capital cost. Additionally, I wanted to see a high price to earnings ratio. A high price to earning ratio shows you investor confidence. If this number is high, it means there's significant growth opportunities, so it's important to look for a high PE ratio. Additionally, I wanted to see a solid EBIT margin. EBIT margin, of course, is a part of the profit margin in the DuPont analysis. It shows how much earnings how much earnings they can generate from a single dollar of assets. So it's a sign of good management. It's where the secrets are, because anyone can pay taxes, anyone can pay interest, but if you can get your EBIT margin up there, it's a sign of good management. And with the relative volatility is sigma I divided by sigma m, and using the equation beta equals the correlation coefficient times the relative volatility, we're able to calculate the relative volatility. If your relative volatility is greater than 1, it means it's more volatile than the marketplace, and if it's less than 1, your security is less volatile than the marketplace. And of course, deciding if this number is too high or too low depends on a person's risk preference. So it's all personal preference when it comes to relative volatility. Okay, now going back to the companies. These are the eliminated companies. I eliminated all these and I left the top 5. And it's important to note that not all of these companies are necessarily in a bad financial condition. Some of them actually are in decent condition, but we're going from 22 to 1, so they eventually do have to be eliminated if they aren't quite as good as number 1. The key points from this slide was there were 3 companies that I found that were in bad financial condition. First is Amedisys. They had a negative ROE and ROA for 2011 and 2012. Lamar had a negative ROE and ROA in 2009 and 2012, and their PE ratio dropped every year, from year to year. So that's telling us that the investor confidence is going down, and there's not many significant growth opportunities. EPL Oil and Gas had a negative ROE in 2009-2010. And this is possibly due to the oil spill and the legislation and the laws that passed after the oil spill. But it's important to know when you have a negative ROE, it means you have a negative net income. So a company, if they have a negative net income, there's no money to be reinvested for future projects, and there's no money to give to the shareholders in the form of dividends. So those companies were eliminated immediately in my eye. And here are my top 5 companies. I liked Mosaic, I liked Marathon, I liked CF Industries, 3M, and Pool Corporation. All 5 of these companies met all of the screening criteria. They had a high ROE, a positive EVA, a solid PE number, and a solid EBIT margin. So these were my top 5. Okay, now that I have my top 5, I want to look at the future stock price estimates and the relative volatility calculations. To estimate the future stock prices, I looked at the historical price to earnings ratios as well as the historical earnings per share and was able to back out the price estimated. When you go looking through each one of these, you can see from 2013 to 2014, the stock prices are dropping for everyone except For 3M, it's actually going up 26 cents, but it's very insignificant. And to calculate the relative volatility, the equation beta equals correlation coefficient times relative volatility was utilized. And you can see the numbers here. Mosaic, Marathon, and CF have a relative volatility between 2 and 2.3, and 3M and Pool Corporation are on the lower side of 2, 1.5 and 1.1. And here's our further ROE analysis. It was important for me to look at the DuPont analysis to see what was actually driving the return on equity. First, I'm going to look at Mosaic. Just a little background, Mosaic produces and markets concentrated phosphate and potash crop nutrients for the agriculture industry worldwide. The key points, I do want to note that these numbers are based on 2012 reporting period. I did look at trends to see what happened over the years, but to show in this presentation, I did show the last 2012 reporting numbers. Key points, they are a liquid company. Their current ratio is almost 3.5. They have an acceptable ROE at 16.34. Their total asset turnover could rise. It's only 0.68. Total asset turnover is sales divided by assets. So they're only getting 68 cents for every dollar they have in assets. So, we want that number at least 1. We want to get $1 back for every dollar we have put in assets. So that number could rise. Their relative volatility is 2, so they're twice as volatile as the marketplace. In their history, they increased their liquidity ratios after the 2008 market slump, which a lot of companies did do that. Mosaic definitely did. And their leverage has decreased over the past 5 years. Okay, to present my the results of my DuPont analysis, I wanted to use pie charts and show percentages to see what was actually driving the ROE. So you can see that the profit margin is 49%. The equity multiplier is 34%, and the total asset turnover is 17%. So the profit margin is driving their ROE. And of the 49% profit margin, the EBIT margin is 6%. Marathon is next. Together with its subsidiaries, they engage in refining, transporting, and marketing petroleum products, primarily here in the United States. Key points, they have a high ROE, 32. They have a great total asset turnover of 2.89. That means for every dollar in total assets, they're getting $2.89 in sales. So they're doing really good in their total asset turnover number. And they have a high economic value added. The history, they've increased their liquidity since the 2008 market slump, just like Mosaic did. Their profitability ratios increased from 2010 to 2011. Their PE is currently higher. Their current number is higher than this number, which is 2012 reported number. So that number has gone up. Their current enterprise value is about $5,000 more than the 2012 reported. So this number is even higher than I'm showing. I'm sorry, this one. And their stock price has risen considerably since 2011. For their DuPont analysis, you can see that their asset turnovers was driving their ROE, followed closely behind by leverage, which that makes sense because Marathon has refineries, has big equipment. They work in the oil and gas industry, so you would expect a good bit of leverage as well. Their EBIT margin is only 1%, so to me that could be improved with management, but definitely their total asset turnover was driving ROE. Next is CF. They manufacture and distribute nitrogen and phosphate fertilizer products worldwide. CF is actually Mosaic's competitor. Key points, they're a liquid company. They have a great ROE with a value of 35.38. Their total asset turnover as well as their PE ratio could stand to improve, and they're 2.0 times as volatile as the marketplace. It is important to note that this 0.64 total asset turnover, this number is low, but yet then again, per industry, it could be okay. Looking back at Mosaic, who is in the same industry, their total asset turnover is only 0.68. So this could be an industry trend, and this could be an industry average, but looking across industries, this number is a little low. Their history from 2011 to 2012, their liquidity ratios increased, so they have more cash. The ROE and the ROA dropped from '08 to '09, and then it jumped back up from 2010 to 2011. In 2010, CF did acquire Terra Industries, so that could be one of the reasons why the ROE and the ROA jumped up after this acquisition. And for the DuPont analysis, you can see that the profit margin is what's driving their ROE with 46%, followed behind by the equity multiplier and then total asset turnover. So of their 46%, they have 10% EBIT margin. Okay, next is 3M. 3M is a diversified technology company worldwide. They distribute products such as tape, glass bubbles used for use in concrete. Key points, they have cash and inventory. You can tell from their liquidity ratios, and that makes sense because they do sell inventory. They have a great ROE with a value of about 27. Their total asset turnover is close to 1, 0.91. A little less than 1, so the number could go up, but very close to 1, better than the other companies we've looked at, except with the exception of Marathon. And they're 1.1 times as volatile as the marketplace. So this company is not quite as risky as the past 3 companies that we've looked at. History, their ROE and the ROA has been consistent since 2007, so no big jumps. Pretty straight across the board. The current PE and P to book is higher than in the past years, so that means that there's significant investor confidence and significant growth opportunities as well. And their enterprise value and stock price has been on the rise since 2011. So 3M, here's 3M with decent numbers, and they have a great ROE and pretty solid company across the board, not volatile. And for their DuPont analysis, you can see that what's driving the ROE is the equity multiplier. Real close behind is the profit margin, only by 1%. And their asset turnovers after that. So they could get this asset turnover like we talked about earlier. They could get this number up. Last but not least is the Pool Corporation. They engage in the distribution of swimming pool and backyard products primarily in the United States, North America and Europe. Key points, they have cash tied up in inventory, which absolutely makes sense because they sell pool products. They have a great ROE, 29. A great total asset turnover. They have a TAT of 2.5. So for every dollar in assets, they're getting $2.50 in sales. So they're doing great in the asset turnover ratio. They have a great PE. Their PE is 23.5. So lots and lots of investor confidence. And they're 1.6 times as volatile as the marketplace. History, the ROE and the ROA has dropped from 2008 to 2009, but it's risen since, and that's possibly due to the market downturn. And the PE and the market-to-book ratio have been rising, and the enterprise value and stock price has been rising. For the Pool Corporation DuPont analysis, you can see that what's driving their ROE is actually the equity multiplier with 40%. They have 2.76 in their debt, and then close behind is the total asset turnover. And here's my summary. In my opinion, the top company is Mosaic. Mosaic has a high ROE that is driven by profit margin, and within the profit margin, they have a solid EBIT margin number as well. So to me, that's a sign of good management. Over the past years, they've increased their liquidity and decreased their leverage. So to me, that's a good sign. The only concern is maybe their money's not working as much as it could for them. But looking at CF, with having the same values of liquidity, to me, it seems to be an industry trend. The total asset turnover could rise, but like I said, their number could be an industry norm. And their relative volatility is approximately 2. And to me, that's of course, it is a personal preference, and I'm comfortable with a relative volatility value of 2. And here's just a comparison of the top 5 of all the numbers. You can see that I did pick Mosaic, of course. Their volatility is at 2. It's not the highest, but it's not the lowest number as well. They do have the highest current ratio, so they are the most liquid company. Their total asset turnover is on the low side, but like I said, compared with CF, it could be an industry norm. Their PE ratio is not the highest, but it is up there, so lots of investor confidence. And they do have a good economic value added number. So to me, Mosaic is the top company.